It's 7:14. Good evening, everyone. Please, if you can hear me, give me one in the chat box. We have behind schedule. I'm so sorry for the taking. Um, I had to put structures in place before I commence the class. I joined the class even far before people joined, but I had to put heavy structure in place so that I don't get to be disturbed while having my class. So thank you so much for joining today. Welcome to Starry Academy. Strategic business reporting, ICAN professional level, and we are in week 5 of our Google Meet live classes. Please signify where you are joining us from in the chat box. Let us know. Let's recognize you, our esteemed student. My name remains Shonibare David, CACTI. And yeah, I've mentioned that. Let us know where you are joining us from in the chat box. Of course, our video lectures for better understanding of the Google Meet lecture topics. It includes the solution to ICAN past questions and ICAN path further. Please ensure you reach out to the admin to get yours today. And let's quickly give ourselves some class guidelines to stay focused. For the best learning experience, it's good to minimize distractions. Very important that we minimize distractions. And how can we go about that? Please put off all your devices. Put them on, you can put it on do not disturb, all right, mode, or you can close all unnecessary apps and social medias that could actually distract you. Engage fully. This might be your only chance to grasp today's concept. Not even when we have a topic that the topic we are looking at today is a quite very important topic. The topics rather we are looking at, we're going to unveil it in some few seconds. Like I said, please ensure you get your ICAN video lectures. It is complementary with this class. This class is not a standalone class. So please do yourself that favor of getting your ICAN video lectures. Sorry, my system wasn't charging. Just a moment, please. Make sure my system is charging. So it doesn't just okay. How do I connect? No. Okay. So ensure you get your video lectures for better understanding of the Google Meet lecture topics. And also it includes the solution to ICAN past questions and ICAN Pathfinder, right? You can reach out to the following numbers on the screen or go to starrygoldacademy.com and you're right there. Now, today's topic is very important. Like I said last week, that today's topic, I used to, whenever I take some topics in class, I always say something that there are some topics that you cannot joke with, right? It's not possible for you to joke with them. And the reason why I said you cannot joke with them is because if you look at how I can test question, I'm a big lover. Many people that know me from LinkedIn, they know my work that I've been doing for about 5 years now. I'm a big lover of patterns. I like to study ICAN pattern of testing question. I love to study trends, question trends, and everything. And I will tell you for free that whenever you look at how I can test questions, there are some topics that you cannot go to diet without seeing them. You can you go to diet without seeing a question from that area. And those areas are the areas I like to call area of concentration, because if ICAN does not test the topic this diet and the following diet you see it, and they don't rest it for more than 2 diets, then they are trying to tell you that, oh, concentrate on this area. That was what I used to pass my ICAN majorly. One of the things, because I was doing a 9 to 5 and I was also running an academics program all the way in Ife. And, it was really daunting. I won't lie to you, very, very daunting. And, I would say it was really challenging, right? So what I used to do was I take my past questions, I analyze it. Which area should the syllabus is voluminous, right? Which area should I give so much concentration to? Which area should I just have an idea? I'm not saying don't read other areas, but there are some areas that you need to put so much concentration on so that you don't just major on the major and minor on the minor, and at the end of the day you say, oh, I can't, it's hard, they did not test what I read. No. So you don't talk like that. It's very important for us to talk about some of these things. So my conclusion was that, my rule of thumb for my knowing area of concentration was, if they cannot go to diets without testing this thing, then if they go to diet max and they did not test it, the third diet they will test it. So that was what I was using to judge. Oh, it seems this area is an area of concentration. Then, and it has been working pretty well. I mean, I have a whole lot of students that can actually attest to that. that whenever I give out area of concentration. Now, employees benefits. Quote me, go and pick up ICAN Pathfinder and start analyzing. The highest employee benefit has gone. The ICAN did not test it. Is 2 diets. If it goes, maybe goes May, they did not test it. Goes November, they did not test it. The following diet is coming. Just expect it. So this is one of the areas I call area of concentration, employee benefits. Now, share-based payments, right, might not really be an area of concentration for me, but we are going to look at it today. Fair value measurement, we are going to look at it also, might not really be. Who can give me their standards? Yeah, quickly, let me see if we are blazing out. I intentionally don't like to put standards whenever I'm teaching, because I noticed over time, then I used to teach FR at the skills level. I noticed students are obsessed with the standard number. I'll tell you, they were really obsessed with the standard number, standard number that does not even make much meaning. Some of them will go and write it down so that they can, according to IS this, according to IFRS this. Meanwhile, they don't even know the provisions of the standard. Is that bad? Right? The provision of the standard is what should actually be your concern, not what the standard itself is talking about. Not what that standard number is. Some people will not even do as far as jotting all the standards down. IS1 is this, IS2, event 3, IFRS 5, non-current asset held for sales and discontinued operation, IFRS 6, exploration for and evaluation of mineral resources, IS 8, accounting estimates and errors, effect of changes in accounting estimate and errors, IFRS 8, operating segment. Is there IFRS 9, disclosures, financial instruments. Okay, no IAS 9. IAS 10, event after reporting period. Is there IFRS 10? Yes. IFRS 10, business combination or consolidated financial statement. IFRS 3 is business combination. IFRS 11, joint venture. And they are trying to cram and understand. I know what I'm saying. By God's grace, I can list all the standards offhand with their corresponding numbers, but I did not sit down one day and say I want to be cramming the numbers, or I want to be cramming, this is where the standard is. By implication of understanding, and none of these standards will I mention or call their name without talking about it or talking about their provisions. The accounting standard. I will not respect you, honestly, if you can just give me the name and the numbers of the standard. I can never respect you. What can make me respect? If you don't give me the name of this, you don't give me the number of the standard, just give me the name and tell me the provision of that standard. Trust me, I'll respect you for that. Just give me the provisions. What I mean by provisions is the basic things that if standard is looking out for: the recognition criteria, the measurement criteria, the recognition, and also disclosures. You don't even need to go far as telling me about disclosures, right? I don't need much things from your end in terms of disclosure. I don't need much things from your end in terms of disclosure. Just give me basically what the standard is talking about, the provisions, and I'll respect you. Are we making any sense at all? So don't cram. That's why whenever I teach in class, whenever I go to my physical class, I just write the name of the standard on the board. I've never said I sat down and not say I want to know. Today, I can. If you call me IAS1, even not for the fact that we are in the process of scrapping IAS1, we are going to IFRS 18, right? I will tell you the regulatory framework and what IAS1 is talking about. I will tell you all the provisions of IAS2, lower of cost and net realizable value, valuation of it. I will tell you all the provisions, the disclosures, the recognition. Talk about IFRS 5, non-current asset held for sales and discontinued operation. See, before you go and sit for CR exam, challenge yourself. List those standards out. Just look at it. Can you talk about something on that standard? Not just listing the names. I was not going to talk about this, but I just had to quickly chip this in because these are things that someone is raising their hand. Please, you have the floor. Say something, please. Let's move on.
So, I like what you are just saying about this quoting of standard. What's the pattern in answering? You must quote the standard number, the name, before you start talking about the details. It has always been like that. Even in the answers in the Pathfinder, it's always. I've tried answering questions without quoting the number, maybe, or misaligning the number, but I don't seem to get it. It has always been the number, the title of the standard, and then you start talking about it. I can't just start now, maybe FRS2. I just start talking about it without quoting the numbers correctly, and I think I will lose mark on that. What do you say?
Thank you, sir. Thank you, sir. I'm not against you quoting. It seems you are not getting my point, sir. I'm not against you quoting the standard number and the name of the standard, right? I have seen students list out standards and their number, cramming it. IS 1 is this, IS 2 is this, IS 3 is this. That's not a good way to learn standards. But like I said, I've never sat down to cram, say I want to cram. What I used to do is, once you understand the provisions of that standard, it is sacrosanct. I'm telling you, you cannot know the provisions of that standard without knowing the number and the standard itself. Let me give you, for example, if you're going to write IFRS diploma exam, they will never tell you the standard to use in application of any answer, any question. They will just tell you use the appropriate standard. So that is the major reason why I'm not saying I'm not against you putting the standard in the exam. Of course, it makes you even look more professional. That you know what you are doing. But what I am against is students cramming the standard without understanding the provision. You see some people, they can even list all the standard up to IS 41, right? And they don't really understand. If you ask them, they have a shallow knowledge of the provisions of the standard. So that's what I'm actually trying to talk down on, not quoting of the standards in itself. I hope you understand what I'm trying to say, sir. So I believe I've been able to clarify that. No, time is not really on our side. In fact, I don't even know how to squeeze myself. I have another meeting to join at 8 o'clock. So please, probably you permit me at 8 o'clock. I have to leave this class, please. So I know I started late. That's 14 minutes behind schedule, right? But I'll try my best. The major thing is for us to cover what I have in mind today, right? So please, you surrender. So let's quickly rub minds. There are certain things I want to really talk about in this regards, in this okay, sir, you are saying something. Okay, can you help us, Mr. Ejikeme? I don't know if I got your your name correctly, sir. Sorry. Please, what are the standards? Just help us. Employee benefit, share-based payment, and fair value measurements. Quickly. What are the numbers? Kindly help us quickly, sir. Are you still there? Who can also help? Next week, wow, my topics. Like I said, usually like, usually don't take person. Okay. Oh, it's your hand.
Sir, your voice is breaking, please.
Oh, it has started again tonight. What's happening? You should not break. Oh, I'm not a break dancer. I hope it's fair now. Please unmute. Whoever wants to say something, please unmute.
Employee benefit. Employee benefit is IS 19.
Okay, good. What about share-based payments and fair value measurements?
Share-based payment is IFRS 2.
Okay. And fair value measurements. We are really smoking hot.
Fair value measurement IFRS 13.
Oh, that's good, sir. Thank you so much, sir. Do you know why I'm asking this? Because I know these three standards that we are treating today, they are not testable at the skills level. Abi, did you see anything like that at the skills level? Did you see anything share-based payment at the skills level? Or you saw anything employee benefits or fair value measurement?
No, I think it's not examinable at scale level.
Yes, it's not. It's not. I've taught at the skills level, and each time we get there, the school management will tell us, oh, no, 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 these are skills level students. So let them still be drinking their milk. What they are doing is simple group, doing the likes inventory. You cannot say anything like inventory. The inventory they will give you benefits and pension plans. Different. We want to differentiate between defined contribution and defined benefit plans. Please, if you have gone through, I'm going to take this. What I do is this my employee benefits class. Time is of the essence. Most times I end up treating only employee benefits in this class because the time I will take to it pays me for you to understand the full provision of one standard than for me to not touch half on each of the standards. Because to be honest, I'll be very honest with you, chances of employee benefits coming out of this diet is higher, is very high. Share-based payments and fair value might not, I'm not saying they cannot come out, don't quote me wrongly, but their chances are low considered to employee benefit. Employee benefit is an area of concentration. So many times when I teach, I always like to focus so much on employee benefits. So now, in your own layman sense, I mean, if you look at it very well, you need to understand, employee benefits. You need to understand what's different. I know how many of us have heard of defined contribution plan and defined benefit plans? How many of us here have heard of it? Please, I need this class to be interactive as much as possible. How many of us have heard of defined contribution?
Yes, I've heard of it.
Defined benefit plan.
I've heard of it, sir.
Okay. That's good. That's good. So we also want to learn how to account for equity settled and cash settled share-based payments. So under IFRS 2 share-based payments, we have two types. We have equity settled share-based payment and we have cash settled share-based payment. But IFRS 2, I used to say something that the major reason why IFRS 2 was set up for was to deal with equity settled share-based payments. That's the major reason why. IFRS 2 was set to deal with equity settled share-based payments. All right. Also to apply the principles of fair value measurement in various accounting scenarios. So we have different hierarchy of fair value measurement, hierarchy 1, hierarchy 2. Who has done this? Mr. Ismail, you want to say something? Have you watched your video lectures on fair value measurement? Hey, this is how I'll start catching people that don't watch their video lectures. Little by little.
Sir, honestly, I have not watched it. Let me be honest.
Hey, and the thing is, there's a reason why we always say watch your video lectures. To be honest, if you watch your video lectures, you'll be able to flow along with me. Now, if I'm talking about hierarchy 1, hierarchy 2, fair value measurement, how do you want to know? It will look like you just be hearing it for the first time. So we need to reiterate this. This class is not a standalone class on its own. You have your video lectures, please watch it. I am begging us. Hey, I am begging us. Exam is approaching real quick. This is a new syllabus. I'm begging us. The way questions will be tested now is a bit different from the way ICAN used to test it in those days. This is SBR. This is not corporate reporting. I'm telling you, this is SBR. Many of the things you'll be doing will be in reporting format. Okay? So who can help us with the fair value measurement? Say something on fair value measurement. Who can help us? I'm waiting. Just unmute. Don't worry. I'm waiting. Time is not on our side. We have about 26 more minutes to spend in this class. Oh, you're done. No one to help. Hey, admin. Huh. Hmm. Who can give? Is there anyone talking on the chat box? Mr. Ismaila, you want to say something? I'm concerned. Do you know why I'm worried? It's because all of these standards are new standards to us. They are not standards that we have done at the skills level, and you are throwing it away like this. I'm scared. Honestly, I'm genuinely just scared because you cannot throw away these standards. You cannot. Are we together? Someone is raising their hand. Please, you can't throw away these standards. You can't. I don't even know where to start. With everything I've like what I just said, it just dropped my morale. Because no one can anyone talk about what is fair value? I believe other standards have treated fair value, they've defined fair value one way or the other. Are we together? Are we together?
Yes, we are.
Lisa, can you help us define fair value? What is fair value from your own point of view, like just from a layman or whatever IFRS says? What is fair value? And there are certain key things to note from the definition of fair value. So that means that if I even talk about hierarchy 1, if I talk about hierarchy 2 of fair value measurement and all those things, I mean, you might not be able to comprehend it. We have hierarchy 1, we have hierarchy 2. I like to call it hierarchy. Some people like to call it level 1, some people like to call it level 2, some people like to call it level 3. So I was not going to talk about fair value measurement before, but let me just give us a summary of fair value measurement. Now, what IFRS 13 is doing is that, please pay attention very well. I wanted to start with employee benefit before, but as it's way, I don't know why my spirit is leading me towards IFRS 13. Right? I don't know. I can't even say. Probably it's going to be tested. So now what IFRS 13 is doing it provides a single framework for measuring fair value. And it also, outlines the disclosure requirements for fair value measurement. Now, this is just still English that we're still using. Who has noticed something that many times most standard will always say fair value, fair value, fair value, fair value, fair value. Almost every standard makes reference to that. If you know you have actually encountered that, please let me know. Raise your hand. Did you notice that most standard like to talk about fair value? They're always saying, oh, fair value. Even IAS2, we say fair value less cost to sales, lower of cost / fair value less cost. Thank you, Mrs. Mary. Thank you for acknowledging that. Every standard like to talk about fair value. They like to say fair. Now, what is fair value? Do you agree with me that fair value, when we talk about fair value, it is an estimate? Do you know that fair value is an estimate? I'm going somewhere. Fair value itself, that word is an estimate. And when it comes to estimate, there's something that you need to take note of. Estimate makes use of professional judgment. Thank you. I love what Mrs. Ifeda is saying in that chat box. Fair value measures the real. I saw something about that. You cannot come to my class and you not pick value. You know something new. You get something new. Fair value measures the real or estimated value of an asset or liability. I love your definition. It's giving me estimate. The fact that I'm seeing estimated there is something. The thing is, I like the way you use the real. The thing is, when we are making use of fair value, so should I be honest with you? It can never be 100%. When we are making use of fair value, that's the major reason why. If they wanted it to be real or to be perfect, they would have called it real value. They would have called it real value. They wouldn't have called it fair. If you say something is fair, like if you ask me that, oh, how was your food? And you say, oh, it was fair. That means that you are not saying it was 100% perfect, and you are not saying it is bad. It was fair. So when you say fair value, is a balanced value, estimated value that you are giving to an asset. I don't know if you are getting my point. So now, over the years, many people have used this value in the wrong way. Did you notice that this standard is not given by the IASC that we spoke about last 2 weeks or so? It was not given by the IASC. This particular standard that we are referring to is by the IASB, because of if you notice many standards that IASB writes or they publish, is usually to correct an anomaly. I don't know if you have noticed that. It's usually to correct a process, something that was being done wrongly before. So many people just use fair value anyhow. Now, the IASB said the time has passed. No one can be using this. Someone will just say, let's make it realistic. So some of us are in Lagos, you can actually relate with me. If I tell you, oh, I go to Computer Village. Now, I bought a device. Let's say I bought that device for, let's say 100,000 new. Now I take that device to the street, to my compound, and probably they now call me that, oh, I need to make a particular payment. So and I now need an urgent money. Please, who is this? Whenever I hear this sound, just to make me lose my line of thought. Thank you, sir. So when can you see I've lost my line of thought? Okay, I was saying I took the phone to the street now to and an emergency came up and I had to like raise fund. Now I gotta meet Mr. A. And I gotta meet Mr. A. Sir, I just bought this new device and I want to trade it up because I am in need of cash. I need to run an emergency. Don't forget I bought that phone for 100,000 naira. Now I gotta meet the man, and the man says, oh, what's the phone? Let me see. This and that. This is it. And it says, how much do you want to sell? I'll tell him, sir, I want to sell it for 100,000. I bought it for 100,000, and I want to sell it for 100,000. And I want to sell it for 100,000, right? Now the man says, oh, but you cannot sell it for the same amount that you bought it at the market now. Don't you think that it's, even though I've used it for maybe 1 day, you say, the value has dropped now. The value has dropped now, and the man negotiates for 80,000. Listen to me, I'm going somewhere. The man negotiates for 80,000, and because of I am in their need of money, I just had no opinion. I had no choice than to beg the man, sir, please, can you do it for 90,000? And the man says, okay, because of you saying you need money, the highest I can go is 85,000. Now you guys reach a consensus and you buy it for 85,000 naira. And the man buys it for 85,000 naira. Now, because of this man has bought it for 85,000 naira, he then goes to tell his colleague at work that he bought this phone at 85,000. Now, 85,000. I still saw it at 100,000 in Computer Village the other day. And because of the man saw it that he bought it at 85,000, does not mean that the same person that is talking to at his place of work can go to Computer Village today and buy it for that same 85,000 naira. Something is playing around in between everything that we are talking about. Now, one thing I want you to know is that fair value is not constant. Situations determine fair value, and that is the major reason why in actually valuing an asset or valuing a liability or valuing anything or equity, when you say fair value, because of this person brought this value and calls it the fair value, does not mean that you also can bring the same assets and call and use that same fair value that that person is using to determine your own fair value. Someone is not getting what I'm trying to explain, because fair value is dependent on a whole lot of circumstances. The same circumstance that this man used to get that device at 85,000 naira, someone else might be able to get that same device at 50,000 naira, but different circumstances. So circumstances determine the fair value of an asset, and that is the major reason why in definition of fair value, the fair value can be defined as the amount or the cost or the price at which an asset or a liability can either be bought or sold or transferred, right, in an orderly transaction. Can you see that I am putting a whole lot of keywords in the definition? It is the price of the amount that will be received. Let me use it this way: that will be received to sell an asset or paid to transfer a liability in an orderly transaction. between market participants at a measurement date. Now, the reason why we are talking about an orderly transaction is that it must not be between related parties. It must, once it is between related parties, it is not an orderly transaction. You know what I mean by related parties according to IAS 24, right? Related party disclosures. Have you done related parties disclosures? Who has done related party? Have you heard of that standard before?
Yes.
You've heard of that? You've heard of that standard before, right? Yes.
Yes.
IAS 24. Good. So you know there are a lot of disclosure, a lot of things there that can make someone a related party, right? Now, it's for it to be an orderly transaction, it must not be, quote me, it must be at arm's length. It must be an arm's length transaction. When you are doing transfer pricing in advanced tax, you understand more about this. It must be at an arm's length transaction. That is for it to be please, some of these things I'm saying, I don't know if you can jot it down because these are keywords when you are talking about fair value. It must be in an orderly transaction between market participants, quote me and unquote, market participants at a measurement date. The reason why I'm saying at a measurement date is because of situations change, conditions change. This measurement date now that you're actually measuring this asset, if you come tomorrow, the price could be different. The fact that I bought this thing today at this amount and I've said, okay, this is the fair value of this thing because this is the price I paid to transfer this, to buy this asset at a particular measurement date, does not mean to be that same amount the following date. That's why they put it there. Right? So we have certain things that we need to talk about here: the exit price, orderly transaction. And please, when we talk about orderly transaction, apart from it must not be related party, it assumes that the transaction is not a forced liquidation or a distressed sales. So that was why I had to use that particular example. Can you see the amount that person used? There was because of that person is buying because he wants to go out, he's selling it because he wants to quickly make sales. It's not, must not, fair value not or a liquidation transaction. It must not be forced liquidation or a distressed sales. Now, because of the bank says, okay, you need to go and sell off, you need to go and liquidate, that's not an orderly transaction because on a normal day, it will not happen that way, right? So we need to talk about market-based. You know, when we say fair value is not entity-specific value, right? It is not entity, it is market-based. It is based on the assumption that the market participants would use when pricing the assets or liability. Now, there are various approaches that we use. Now, what fair value measurement is trying to do is that it's trying to put structures in place when people are using fair value. For example, now, for companies that do valuation of their assets, valuation of their liability, they told them there are various techniques that you can use to value your assets, your liabilities. There's market approach, we have cost approach, and we have income approach. SFM students, don't sleep. SFM student, I'm calling you specifically, don't sleep. When you hear words like market approach, cost approach, income approach, it should be telling you that valuation is happening here. So, you know, we have different valuation techniques that we make use of: asset-based valuations, we have income-based valuation, we have market approach, we have free cash flows or cash flow based. So when we talk about cash flow based, we can talk about free cash flow. We have DCF, discounted techniques, right? So in fact, you can also do valuations using option pricing, right? I don't know if you have done all of this with SFM, because I lecture SFM also. That's why I can actually talk about some of these things. Now, when we talk about market approach, I need you to understand each of this. And please, SFM students, understand your IV, International Valuation Standard, IVS, right? Understand International Valuation Standard very well. So this approach, when we talk about market approach, this, if you want to get, let's say, for example, now, you are looking for the amounts to be used to carry your because of the standard says fair value, your inventory says, to measure your inventory, it says lower of fair value, less cost to sales. That's lower of costs, and fair value, less cost to sales. But you don't know the fair value to attribute to that particular inventory. Now, you can go to the market and say, okay, let's look at what is the price that, you know, you can actually sell. We have a similar asset in this market. Let's say, for example, you are into car sales, and you know the cost already that you have used to purchase that car. Now, but you need to use valuations. inventory, that's IS2, says lower of cost and fair value less cost to sales. Now, you already know the costs that you incur if you want to sell it, right? But you don't know the fair value. Now, that is the major reason why IFRS 13 is coming into play. So you know the right techniques, because you will disclose all of these things. You will see, you can't check the proper financial statement. You will see all the related disclosures related to fair value, how they've done it, the method, the techniques that they've actually made use of. Are we making any sense at all? So it's very important for you to consider this. I can test IFRS 13 very well. So don't say they will not test. They've tested it. Might not be an area of concentration, but they've tested it very well before. Are we making any sense at all? So this approach, what is telling you that for you to know how to value that inventory, go to the market, go to Computer Village, go to Alaba, go to different places. I'm just using that as an example, of course. Go and look at the amounts that similar inventory is trading in the market. That's a market approach. Are you getting me? That is what we call the market approach. So you are trying to generate relevant information from the market, right? It uses the price and other relevant information generated by market transactions, and it involving identical. That means that similar assets or comparable asset or liabilities. You are going to the market. Oh, how much are they selling this Lexus 350 in the market? You are benchmarking, and you can just at the end of the day take an average, right? That is market approach. Now, cost approach. You know, when we talk about cost approach is just trying to reflect the amounts that will be required to replace that current asset, that current service capacity of the asset. Don't let us use English or Igbo to try to make everything look nice. Cost approach is usually the current replacement costs. Now, many people used to mix this up that, oh, market approach, this and that, cost approach. The idea is there will usually be an amount that an asset or a liability will be trading in the market, as it were. So you could just take the benchmark, right? Now, if you talk about the current replacement cost can actually, now let's say that same asset, that RX 350 now, you want to replace it. You want to buy it, right? Or okay, don't forget that we're actually looking at for the fair value. And someone has said, okay, to replace this now, if you want to replace RX 350, replacing it to be the same one that they should be, that RX 350 is 2007 model. It has been in your store for 7 months. It has this current mileage. If you want to replace, you find a similar asset that you want to, okay, you need to go and ask, if you want to replace this same RX 350 and it must have the same characteristics of this RX 350 that we are currently having, that we want to get the fair value, what will be the cost to replace it? You know, it's different from market approach. That you go to the market, go and be looking at, okay, how much are they selling a normal RX 350? That one is different. This one is the replacement cost in the current service capacity. Please quote me and unquote me. I'm not just saying replacement, in the current service capacity. So if you are going to look at what does your phone worth in today's market and you want to use cost approach, you can look for, okay, is there someone that wants to sell the type of my phone now that has used it for 7 years that I've used it for? The screen too has cracked, right? How much should that person sell it in that current? I'm making emphasis on current service capacity so that you not quote me wrongly. That is the right thing to do there. That is cost approach. Now, the third one, valuation technique under IFRS 13 is income approach. Now, what this one is looking at is that it says that what is the amount that you will generate from continuously using, assuming that you don't want to sell this asset, or you don't want to replace it, or you don't want to go to the market and see how much it's trading. If you continue using it, how much will you get from that asset into the unforeseeable future, into the future? Now, if you look at all the income that you can generate from that asset into the foreseeable future, it now tells you to discount it to present value. That is the ideal fair value. So inside, between the three of these, which of them do you think is more accurate? Will give you more accurate valuation. That one is not left to me to decide. It's IFRS that will decide that. But to be very honest, I want to just hear our opinion. Which of them do you think would give you more accurate valuation?
Income approach.
Are you sure? No, to be very honest.
Value.
Someone is saying market there. Someone is saying market. No one has said cost. To be very honest with me, you will know the one that will give it. Okay, good. I'm not going to decide now. Now, let's go to the next thing. you will see that you will change your mouth on some of the things you have said. The standard now did not stop there. For you to know the most appropriate one, right? It now went further to explain the hierarchies of valuation. Now let's go to the hierarchy of the valuation. So those of you that have said, I love IFRS so much. You know, I said something like it is principle based, but there are times that it will give you what it wants you to do, but it will not just mandate you that do it this way, do it this way. Now IFRS 13, the IASB now did something in IFRS 13. They now called it fair value hierarchy, right? When they wanted to get started with this fair value hierarchy, they said, in order to increase the consistency and comparability in fair value measurement, they now decided to introduce a fair value hierarchy, right, that prioritizes the inputs used in valuation techniques. Don't forget that every technique that you are going to use now has an input that you are going to make use of, right? So they now said that there are some particular inputs that are observable, and there are some particular inputs that are unobservable. Now, they now decided to come up with an hierarchy of valuation, right? When people are doing measurements, this is the first thing that they should consider. This is the second thing they should consider. This is the third thing they should consider. Now, they said that this hierarchy that they've come up with, level 1, level 2, level 3, has been influenced by they trying to maximize entities making use of more of observable inputs than making use of unobservable inputs. Now, if you talk about observable inputs, let's say market approach for an example. Market approach is saying you have similar entities that are actually having this. Let's even say you are trying to value shares of a company. Oh, you have a similar company in terms of size, in terms of PE ratios and all of those things, and it's trading on the stock market. Why don't you just take it, right? That is an observable input. Since you have seen it that, since we have the PE ratio is the same, this is the same. Those inputs that you are using to determine the valuation, the fair value, they are observable. That's what they are saying. So they said that you need to, in considering, they introduced a fair value hierarchy that prioritizes the inputs used in the valuation technique. And they said that entities are required to maximize the use of observable inputs and minimize the use of unobservable inputs. Right? So let's look at level 1. I will stop. When I'm done with level 1, 2, 3, I will stop and briefly have time. See, in some of these standards, I'm someone that I like to explain standards because standards are just like law, and interpretation matters a lot, and that's the major reason why there will always be arguments. A friend of mine just chatted me up on Sunday and sent a very funny. I posted it on my status, and I've been seeing different opinions. You know, I'm someone that likes to be around where they are discussing standard, because when you discuss standard near me, at times the judgment people give to accounting standards are usually always very tricky, funny at times, and I'll just be laughing because, of course, it's IFRS that have caused this, because it just stated objectives, it stated provisions. It did not tell you do this in particular, right? So the question was, let me just leave it for you guys. A motor vehicle held for rental service by a car rental service company is accounted for in line with the provisions of which accounting standard? Let me go over it. The question that my friend asked me is that a motor vehicle held for rental service, for the motor vehicle, they are holding it for rental service by a car rental service company. So the company is into rental services, is accounted for. That motor vehicle itself, how should it be accounted for in line in which provisions, the provisions of which standard? They said, is it IAS 2, IAS 16, or IAS 40? I've been seeing different answers, but that one is by the way. Okay, so let's go back to our standards, our hierarchy. We have level 1, that is the highest priority. Highest priority, that is level 1. And the standard says that the highest priority, that the first things that you must consider when you are valuing
Sir,
The network is breaking. We are not
it's
hearing you,
breaking,
sir.
sir.
Oh my goodness, why network? What about like this?
We can hear you now.
I hear you now.
Okay, so the standard says for level 1, you need to first ask yourself, are there unadjustable quoted prices in the active market for those identical assets or liability that the entity can access at that measurement date? Did you get what I'm trying to say? They said the first hierarchy of measurement that any entity should consider is level 1. Ask yourself, that's the first thing that you should prioritize. Are there any unadjustable quoted prices already? Okay, so for this motor vehicle now, is there any quoted price in an active market for those identical assets or liability? I like to make use of shares now whenever I'm doing an example of this. You ask yourself, so these particular shares that we want to value now, let's ask ourselves, is there any quoted price? So for example now, if I want to value the share of Nestle, that okay, what's the current share price of Nestle, right? And maybe I bought their share, I don't know. If I can go to the active stock market and just extract it, it's very easy for me because Nestle is traded on the stock exchange market. I can easily go, so no need to be saying, let me look for, is there a company that is similar to Nestle when their shares are already quoting, they are already trading and it's unadjustable. What I mean by unadjustable, you cannot influence it. It is the share market, it is the stock market, the active market for it, right? The current amount that it is being traded for, right? And it is, and the entity can have access to those particular, not just say, oh, is it quoted? Can you have access to it at that measurement date? That's what we mean. So level 2 is input other than level 1 quoted prices. What we mean by level 2 is input other than level 1 quoted prices that are observable for the asset or liability. This can be directly or indirectly. Now let me explain this. Level 2 is a bit below level 1, right? Now, for example, you went to that market, you did not see any quoted share. So what is the next thing for you to do? You can easily go to level 2, make use of level 2 pricing. And level 2 is you just say, okay, can you observe something that can point you to the price? You can observe, okay, you did not see the price of Nestle, but there's another company on the stock market that is having maybe an identical interest rate, yield curve, or probably PE ratio or any other ratio, or they look similar to that Nestle. If they are, that is already an observable input because of you can observe it that okay, let's see, this is the interest yield, this is the interest rate of this company. It's looking similar in terms of this, and let's look at it. It's looking similar. You are observing it is observable. You can look at a trend from it that okay, how have they been observing? You observe their trend and everything. What you are doing there at that moment is level 2 because it's not a direct. If it's a direct price from the active stock market, that's level 1. But if you are trying to observe, it looks identical. It looks this. You are already using level 2. Don't deceive yourself. Now that's level 2. Now level 3. Level 3 is the lowest priority. Level 3 are unobservable inputs for the asset or liability, which an entity must develop using the best information available. So this is where you make assumptions. You can make use of the entity's own data or assumptions about their cash flow. And to be very honest with you, most times people in level 3 usually make use of income based approach. I'll still leave it for you to decide. But people in level 3, most of them make use of income based. This is where they start to discount. Okay, let's look at discount back to present value. They are trying to calculate it, observe it. It's an unobservable, right? Imagine you are looking at, okay, you are trying to forecast. Because if you say you want to use income into the foreseeable future, it's a forecast, right? You need to do actuarial to carry out an actuarial guide. And that actuarial is being spoken about in employee benefits. Use of an actuarial or the use of actuarial measurements and all of those things. So those are the 3 hierarchies. So I think I've been able to summarize. That's basically what IFRS 13 is talking about. That's all. Can you see that IFRS 13 is not much, right? Though ICAN might decide to be tricky. You see proper exam questions, but it will still be built around the basis of this IFRS 13 that we have spoken about. Now, oh my goodness, time. Oh, I ran out of time. Oh, 8 o'clock. Hey, I don't know. Let me see if I can chat up and give me some minutes to join the meeting. Just a minute, please. I want to touch employee benefit a bit. Let me see. Just a minute, please. Okay. Let me just take the next 7 to 8 minutes and round off. Okay, so I've spoken about this to apply principles of fair value measurement in various accounting. I believe it's not what I've explained. I believe so. Which who is going for approach there? Someone was going for income approach. Yes, someone was going for income approach. Hello. Am I still on call? Or oh, this call has not ended, chat. Okay, so please just to reiterate, to get the most from this let's see, please get your video lectures. It's very important. You understand it more when you watch your video lectures. Okay, so let's look at the lecture outline. You know, this week's topics are based on chapter 14, 15, 16 of the comprehensive video lectures under the subject employee benefits, share-based payments, and fair value measurement. So under employee benefits, we look at the nature and differences between defined contribution plans and defined benefit plans. So let me just give us quickly, when we talk about the under employee benefits are used to explain all the benefits that accrue that you pay to an employee that is giving you their service, right? So you need to pay them. It could include termination bonus, salary, wages, leave allowance, all of those things. They are all employee benefits, right? So the standard was not able to group some under short-term benefits and long-term employee benefits. Please, I will explain together. Just like I'm just talking to myself. Are we together? Okay, give me an emoji if we are together.
Yes, we can hear you, sir.
Okay.
Though it's breaking, but we can hear you.
Okay, sorry about that. So the standard decided to there's short-term employee benefit. Those short-term employee benefits very, very easily accounted for. You recognize the employee benefit that you have paid. So don't forget that when those employees do their performance obligation, or they certified the vesting conditions for those employee benefits, right? So you have to recognize that employee benefits. Let's say for the month of August now, you are still working. So once it is 31st or 30th of August, you need to recognize that, oh, this employee has actually giving what a service to us, and recognize current service costs. So you need to what's the journal to raise? What's the journal to raise immediately? Irrespective of whether cash has gone or cash has not left. What's the journal to be raised? Hey, professional level students. You don't know the journals to be raised. To recognize. So we are using accrual basis now. So you need to I'm talking about short-term employee benefits.
Sure.
So the journal, what's the journal? Who wants to try?
Repeat the question, sir. Let's.
Okay. So at the end of the month, for short-term employee, do you agree with me that salary is a short-term employee benefit, right? So at the end of the month, we've said the standard says we should, irrespective of whether cash has been paid or the employee has been paid, we should recognize once the employee has performed that service, rendered that service, they've satisfied their own performance obligation. You need to recognize the costs of that service immediately as a current service cost. So what is the journal to be raised to recognize that? Let's say, let me give you a figure to make use of. Let's say the employee is being paid 150,000. So at the end of the month, they've immediately after August 30th, that they've performed their service for the month, even though they've not been paid. What's the right thing to do there to the books?
Even though as an accrual, you credit the employee benefit. and
Okay.
debit cash out. I didn't grab it very well, but I think the employee benefit should be credited
I'm not
until it
asking
is
for the. Okay. Okay. Okay.
they
You
just
tried to.
penalize until paid.
Okay.
Then you
See,
refine.
okay. The thing is, I noticed something that many, even chartered accountants, struggle with journals. If you don't know journals, you will really struggle. I've been at interviews where you see a chartered, even FCA, struggling with journals. And it's just very simple. I don't know why many people struggle with journals. It's very simple. Yeah, I understand accrue for it, but how you can write accrue for it in the accounting package or inside your books? What should you debit? What should you credit? Of course, there's an account called salaries and wages account. There's an account there's a liability account. You need to recognize a liability account that will be called employees benefits, but it can be maybe short-term employee benefits or accrued salaries and wages accounts, right? So of course you need to have debited the salaries and wages, credit the liability account. Are we making any sense at all? Now, when cash is being paid, you go and reduce, you debit that liability account and you credit cash account or bank. Are we making any sense? Because cash would have been suffered, cash or bank must have suffered that debit. So of course you need to go and reduce it from cash and also derecognize that liability by debiting that account because you have credited it initially. So that's just a simple journal to go with it. Are we making any sense at all? So short-term employee benefits, the standard believes everyone knows how to deal with this, right? Now, the major reason why this IAS 19 was set up was to discuss long-term employee benefits. Long-term employee benefits is pension, gratuity, and all of those things. Now, when we come to long-term employee benefits, talking about pension, gratuity, the standard says there are two types. We have defined contribution plan and defined benefit plan. Now, defined contribution plan is a particular plan where the two both the employer and employee would have a constant amount that they are both contributing towards retirement. That's what we are currently using in Nigeria. Contributory pension. What's the current rate of contributory pension? Let me see if we are updated. What's the current,
18%.
sir?
Contributory pension.
Yes, sir.
Employer 10%, the employee 8%. So
Very good.
18.
Very good, sir. I thought you were going to say 7.5, 7.5.
No.
Thank you, sir. You're updated. So now there will not be fights at the end of the day when you contribute your 10%. The employer contributes their 10%. I also contribute my 8%. At the end of the day, everybody will have their 18%, right? And they will smile when you retire. They will just bring it. You have kept it with your various pension fund custodians, and they've invested it in whatever they want to invest it in a special vehicle or SPV, special purpose vehicle or whatever. Now, where the issue used to come from, I used to say something that this standard IAS 19 was specifically set up to treat defined benefit plans. They don't have issue with defined contribution plans because it's what you contribute that you will see at the end of the day. The problem used to come from defined benefit plan. Now, what is defined benefit plan? So an employer will assure you, don't worry, at the end of your service year, this is the fixed amount we are promising you that you will get. Now, the employer can decide now to open a fund for it. That's a funded plan. They can decide not to open a fund for it. What I mean by a funded plan is they've kept an asset where they are crediting, right? They are crediting it every month or from time to time, so that they are saving towards that particular plan, that particular promise that they've given to you. Now, don't you think that we need to measure the liability that we need to disclose in the financial statements? Because we have promised this person that at the end of this year, this is the amount they are going to have. We need to disclose it. We need to disclose the amount that every year should be debited as an expense. We need to disclose the current service cost. We need to disclose the past service cost. We need to do a remeasurement every year. We need to do a remeasurement the liability, is it still the same? We need to know, and that's when we need to call an actuarial. An actuarial is the one that will calculate the amounts that we need to be funding every year, that we need to be using to calculate that, okay, they are the one that even give us the rates that we use to discount. I don't know if you are getting my point at all. So that is the major problem is when we look at IS 19. So you need, time is not my side, honestly. I think I need to go. Please go to your video lectures, go and watch IS 19, and trust me, I watched IFRS 2, and trust me, if you have any question, drop it on the platform. So I need to sign out at this moment. I'm already being nudged from a different angle. So you can, these are some of the questions. You can find it in the members area. The question is not even complete. There's a case study to it that I don't know why it's not included here. So next week, like I said, we'll be looking at a very important question. A very, very important one. A very important topic. We'll be looking at where is it? I've not seen it. So we'll be looking at financial instruments, and financial instruments happens to be your chapter 17